Transfer pricing and arm's length principle for related parties in UAE corporate tax law. In business transactions involving closely linked parties, often referred to as related parties, there exists a risk that their relationship might influence how transactions are priced or structured. This is particularly concerning for tax authorities, as such parties may have an incentive to manipulate transaction values to gain a corporate tax advantage. To counter this, specific rules ensure that transactions between related parties reflect market conditions, preventing unjust advantages and preserving tax equity. Requirement to apply the arm's length principle. When engaging in any transaction or arrangement, related parties must adhere to the arm's length principle. This rule mandates that the price, terms, and conditions of such a transaction between related parties should mirror those that would be agreed upon if the transaction were between unrelated and independent parties acting freely in the open market. In essence, this principle demands that the economic reality and substance of a related party transaction are consistent with what would be expected in a comparable transaction between independent parties. Adjustments by the Federal Tax Authority, FTA. If the price or terms of a transaction or arrangement between related parties deviate from what would be considered at arm's length, the Federal Tax Authority, FTA, has the authority to intervene. Specifically, the FTA can adjust the taxable income of the taxable person involved in the transaction. The goal of this adjustment is to align the taxable person's income with what it would have been if the transaction had adhered to the arm's length standard, reflecting true market conditions and removing any artificial tax advantages gained. Corresponding adjustments for related parties. Whenever the FTA makes an adjustment to a transaction involving a taxable person to ensure compliance with the arm's length principle, a corresponding adjustment must also be made to the taxable income of the other related party involved in that transaction or arrangement. This adjustment ensures that both parties to the transaction are treated consistently under UAE corporate tax law. The intent is to maintain a balanced allocation of profits and prevent any unintended tax implications arising solely due to transfer pricing corrections. Ministerial Decision No. 134 of 2023. Ministerial Decision No. 134 of 2023 outlines the procedures and required adjustments when calculating taxable income arising from the transfer of an asset or liability between related parties. These adjustments are crucial in maintaining compliance with the arm's length principle and ensuring tax neutrality in related party transactions. Foreign Tax Authority adjustments and corresponding adjustments in the UAE. In situations where a foreign tax authority makes an adjustment to a transaction involving a UAE taxable person to align it with the arm's length standard, the UAE taxable person has the right to apply to the FTA for a corresponding adjustment to its UAE taxable income. This step ensures that the allocation of profits between the jurisdictions involved remains consistent. Such adjustments are particularly important in preventing double taxation or, conversely, double non-taxation that might arise from conflicting transfer pricing decisions by different tax authorities. A corresponding adjustment reflects a change to the corporate tax liability of a UAE taxable person to align with a primary adjustment made by a foreign tax authority. This is done to ensure that both jurisdictions allocate profits in a manner that is consistent with the arm's length principle. By coordinating adjustments, the risk of double taxation on the same income, or the opposite scenario of income escaping taxation altogether, is mitigated. Example scenario: transfer pricing adjustment. Consider the case where Company A, a UAE-based manufacturer, sells products to Company B, a related entity in another country, at a significantly lower price compared to what it would charge unrelated parties. If the foreign tax authority in country X adjusts the taxable base of Company B to reflect a higher arm's length price, Company A can apply to the FTA for a corresponding adjustment to its UAE taxable income. This adjustment ensures that the income reported by both companies aligns with market norms and avoids double taxation.